tax class. This will be a good makeup class for the exam that's coming up. Because I do use a lot of concepts from the tax class in this, because this is the tax module. Now, as wealth managers, you guys do what? You manage your client's wealth, right? And so you have to understand not only how to do that, but the tax effects of managing a client's wealth. And this is small letters, but if you can read. The red is today's class, the blue is next week's class, and the green is the last class. So it's broken up into three classes. Today's class is rather meaty. It deals with the tax effects of your clients, whether they be your clients being U.S. citizens doing business abroad, which is important to know, or your clients being foreigners doing business in the U.S. And I use the U.S. as an example because the U.S.'s regime for international taxation, one is rather sophisticated, and two is the regime that a lot of other international countries base their taxation on. And so when you're managing a client's wealth and managing where they're investing and the type of business that they're doing, the tax effects are very important. And so we will go through that. So we'll do a basis understanding of capital gains versus ordinary income. That's like a baseline fundamental understanding of when you're investing your clients and what types of assets you're investing them in and for how long, and then how the tax effect of that is. Then I said we'll talk about U.S. persons and their foreign income, because that has a bearing, and then we'll talk about foreign persons and their U.S. income, because a lot of the, like I said, tax regimes in the world follows the U.S. international tax framework. And then we're going to talk about foreign trusts, foreign entities, controlled foreign corporations, which almost every country in the world now is picking up on controlled foreign corporations and how their tax regime is done. And that'll be the first class. This is rather meaty. The second class is always the class that everybody in the financial world wants to talk about, and that is the transparency. That's TIAs, FATCAs, CRS, multilateral versus bilateral, all of that interesting stuff, right? And then the last class, we're going to talk about structuring for clients in this world. What's the best structuring? Tax-deferred structuring, that's legitimate tax-deferred structuring, lifestyle planning, how you remove a client out of the entire global tax regime properly, and what we do. And so that'll be the full class. 3 classes going forward. Now, although I think I do know all of you, we'll go around the room and do small introductions, name, and institution that you're with.
Wyndon Miller, no financial institution with social services,
Right.
probation officer.
Nick Wright, Morgan & Wright Asset Managers.
Barnett Scott Gay, UBS Trustees, Bahamas.
Mhm.
Ruby Nottage, University of the Bahamas.
And one of the best judges this country.
So I've heard.
So the first slide, and I might say, my former teacher in law school, and taught me everything I know.
Yeah,
And-
you're such a good student. You knew it all.
And so,
He's still a Noel.
much of my career, you can attribute to the teachers of my past, and I thank my teacher in the classroom, and now I get to teach my teacher. So we're talking in the first few slides, capital gains versus ordinary income. What is the difference? Those who have experience in the United States, this underpins much of the income tax regime in the United States. Ordinary income is usually income other than capital gain income. We always define tax matters as something other than something else. Ordinary income is everything that's not capital gain. Usually it's wages, it's salaries, tips, commissions, bonuses, that type of stuff that's on your day-to-day type of activity, your compensation, your work activity, that's all ordinary income. The distinction is important because ordinary income is usually at a higher rate than capital gain. So when you're investing client assets, you want to know whether it's going to generate ordinary income or it's going to generate capital gain.
You talking about the US or the whole world?
Generally, over the world, ordinary income is always at a higher rate than capital gain.
Really?
The policy behind that is because capital gain is really, we'll go on the next slide, is really gain from the investment in something. So from a policy point of view, you want to encourage investment into assets.
Right.
And so you tax the gain there at a lower rate to encourage people to invest rather than to make money through investments rather than just spending up all their money in ordinary income, right? That's the policy behind it. So, rent, if I rent a house and I'm getting rent, so if you say, okay, I'm going to invest my client's assets in condo buildings in Miami, I'm gonna rent them out because the Miami market looks good, know that that income from the rent is ordinary income and taxed at a higher rate. The income related to the investment in the property, the rise in value and gain that you get from the property is capital gain at a lower rate. So you're going to have different rates, and which is important to the return on investment. Because if your tax rate's higher, your return is lower, right? Because it's only on income. Short-term capital gain is taxed generally at ordinary income rates. So if I invest in a piece of property, and short-term is usually less than a year, if I invest in a piece of property, you say, okay, that's a capital asset, that should be at a lower rate, but I sell it in 6 months because it goes up so high. I'm going to be taxed at the ordinary income rate, not the long-term capital gains rate. So, US, this is about between 27 and 39% for ordinary income. Capital gain long-term is 15%. Right? So you see it's a big differential in rates. So ordinary income rate, rents, royalties, compensation type of income, income generated from not investing in capital, right? Capital gains, and this is where a lot of your clients, they say, I want to invest and I want to invest in capital assets because I want to get a capital gain because my tax rate's lower.
Good evening.
Hey,
How you doing?
good, how you doing?
Oh, thank you.
You're welcome.
I think I've got one of these actually.
I have one.
No,
Yeah,
mine's
we have
this is
one.
different. Oh,
Those are
it's
for
the
everyone else, but
same. Is it like that?
those are just the copies.
Those are for the absent people.
Like me. I'm gonna need one.
What's your name?
Jonathan Ferguson,
Where do you work?
Scotiabank.
Nice to meet you. Scotiabank or Scotia Trust?
You don't need an introduction.
Jonathan Ferguson.
I know who you are.
I'm Ryan Pinder.
Yes, thanks for letting me know.
I'm the teacher for the night.
Not yet, thank
Sure.
you.
Let me get, anybody say they have one though?
No, but I mean,
Everyone else is in here, yeah.
This people be coming in around
Oh,
6:30, so.
So capital gain is profits from the investment in a capital asset. So a stock is a capital asset. Real property is a capital asset. So anything that's the capital asset generates capital gain. Right? And so if I invest $100 in a stock, and I hold that stock for a year and a day to make it long term, and I sell it for 125, it's gone up in value. What's my gain?
25.
$25. And if the tax rate would be lower, it'd be 15%, right? So it'd be what? $3.75. If I was in the 33% tax bracket, it would be a third of that, which would be much more than $3.75, right? And so that's why your clients, if they're tax sensitive, they're going to want you to invest their assets in capital gain assets. So and hold it long enough to get long-term capital gains, right?
Is the 1 year period typical for most jurisdictions?
It is typical for most jurisdictions. The 1 year period is generally the threshold between short-term and long-term capital gain. And that's pretty universal, right? And so if you're always trading on the guy's account, you're churning the guy's account, you're generating ordinary income for him, right? So if you're always churning the account, you're generating ordinary income. Assuming that he is declaring his taxes, he would now have to be paying ordinary income rates on all of that, right? So that's capital gain versus ordinary income. It's a baseline fundamental issue about when you're investing client assets. And I thought that was an introduction to understand how income tax works, to understand how the tax differentials are important, and when you're investing clients' assets, to understand in the type of assets you're investing in client, right? Just as a summary, I invest in real property, right? Real property is what? It's a capital asset, right? So I invest $100 in a condo building. That condo building generates $50 a year in rent, right? I'm in the 33% tax bracket, let's say, on ordinary income rates. Capital gains rates are 15%. Right? So I generated $50 in year one. Right? I sold it year one plus a day for $150. Right? That's my proceeds. What's my net tax effect to my client? He's got $50 in capital gain, right?
He's got $50.
Long term,
$50 at 15%.
and right,
And $50 at 33%.
at 33%, because that asset is producing both types of income. It's producing ordinary income on the rent and capital gain on the sale, right? And so that's a multi-rate type of asset for my client. Now, my client may be okay with ordinary income. Why? Because he may have a bunch of deductions for tax purposes, which will reduce the taxable income. Right? So let's say I have $50 in ordinary income that year from rent, and I have deductions from other activities, right? Where I'm running losses and I'm got other deductions of $25. I can deduct that, and my net taxable income is really $25, not $50. Right? Because I have deductions to use. So my client may say, look, I can't use my deductions on capital gains because generally deductions are ordinary income deductions. Generate me some ordinary income. I'll neutralize it out with my losses, and therefore I'll be in a tax preferred position because I'll have zero tax in ordinary income and I have a capital asset appreciating. Right? So you don't know how to really invest your client's assets in a tax optimized position unless you know their tax profile.
Deductibles, do they expire?
Depends on the jurisdiction. Generally they do. They only have a finite period of carry forwards. So you can't carry forward necessarily indefinitely. That's why I may say generate me some ordinary
That's why I was
income because
asking.
I have carry forwards I have to use.
Yeah, that's what I was asking.
Right? Okay. And like I said, we use the U.S. tax model in demonstrating some of these concepts because it's very sophisticated and well defined. U.S. taxation of a foreign income of a U.S. person. So, we have U.S. people here in the Bahamas. You'll have U.S. clients. They may live in the U.S., they may live in the Bahamas or somewhere else. And you're managing their assets, right? And you're managing their activity.
It's not that hijack.
Not that high tech yet, eh? I trust this computer every time. And so you may be having to deal with his tax situation. This can be akin to other jurisdictions, right? So this is, you are a U.S. person. What's a U.S. person? If you're subject to U.S. tax, right?
Mhm.
You're subject to U.S. tax when? When you're a citizen or
Green card.
a green card holder or meet the residency test. We'll go through that. Once you're a U.S. tax person, you owe taxation on your worldwide income, right? That's why it's important to know if your person's a U.S. person. And this is important in the era of asset management in the Bahamas today, because where's our new growth in asset management? Where are the clients coming from?
United States.
Latin America.
Latin.
Do you know one LatAm family who doesn't have a child who's a U.S. citizen or U.S. taxpayer?
They always got somebody in here.
Somebody always has a green card, somebody's always living in the U.S., working in the U.S., married somebody in the U.S. when they were at school, right? And so you have to be able to manage the assets, understanding the effect on U.S. persons, and more so in the Bahamas today than before, because before we were European-based. Most of our clients now are LatAm-based. So this is about U.S. persons and their taxation of foreign income, okay?
press the arrow or the move? Oh.
Okay. So again, what's a U.S. person? And this is important for your clients. A U.S. person is U.S. citizen. So if I have a passport, U.S. citizen, period. No matter if I never step foot in the U.S. Okay, we have two new people, a little bit of introductions. I'm Ryan Pinder, your teacher.
I'm Glenn Lawrence, your student.
From which institution?
Well, I'm an adjunct lecturer here at this.
Perfect.
Ross, Laverne Ross, Scotiabank.
Scotiabank. We got two Scotiabanks in here. Good. Because the Canadian banks are the ones that really take the U.S. people. Not the Swiss.
Way back to them.
So, you're a U.S. citizen, right? If you are carrying a passport, you're a U.S. person. You can be born outside the United States. If one of your parents are a U.S. citizen, you can be a U.S. citizen. That's how I got my citizenship. My mom's American. I was born here. For those who've been around a little bit, in Rosson's Hospital.
Right.
Dr. Rosson born me,
Right.
right? My mom was American, my dad's Bahamian. I got U.S. citizenship from my mother. Right? Now I've renounced, I've gotten rid of it, but that's how I got mine. Or you could be a tax resident. And this is important for your clients because our LATAM clients spend plenty of time in the U.S.
Yes.
Right? And more so in asset management today, you're not just being just a manager of the assets. You're more and more becoming a partial family office. And more participating in their lifestyle planning. That's the last class, which we're going to talk about lifestyle planning for your client. So more and more, those who are managing their clients are becoming intimately involved in the client's lifestyles. And therefore, you need to know, for those clients you have that travel the world and you're investing their money, whether they're susceptible to being a U.S. person or not. So they may not be a citizen, they may not be a green card holder, but they might meet the substantial presence test. So you can be a tax resident of the United States if you're not a citizen if you satisfy one or two tests. One's a green card test, that's easy. If I got a green card, I'm a tax resident, I'm taxable on worldwide income. You can have a green card and not fulfill the residency requirements of the green card. So for immigration purposes, it's no good. But for tax purposes, you're still regarded as a U.S. taxpayer. Right? So all them Bahamians, they get a little green card on the side just for insurance, right? And you never use it, and you never reside in the U.S. and say, well, they ain't no good. No, you're a taxpayer, right? Latin American families, they get green cards like it's going out of style. Chinese,
Yeah, Asians, yeah.
like it's going out of style. Taxable on your worldwide income. So, green card holders, like I said, you're taxable on worldwide income if you hold a green card. You have an income tax filing requirement, obligation to pay taxes, right? Even if your green card has been determined to be abandoned for immigration purposes, you hold it, you're still taxable, right? Substantial presence test. This is the one we always advise our clients, right? Don't go 183 days. I know you go to the States plenty. Don't go 183 days. Well, that's wrong advice, and we'll talk about that. But you're a tax resident if you meet the substantial presence test. The substantial presence test is this. You're in the United States at least 31 days during the current year, and 183 days during a 3-year period, according to this formula, right? So what does that mean? You'll see all days in the current year, a third of the days in the year prior, a sixth of the days in years 2 prior. So really, the rule of thumb is this that you give your clients. Because remember, if your clients are U.S. taxpayers, they're taxable on worldwide income in the United States, which affects the way you have to invest their assets, because they're taxable in the United States. So the rule of thumb is not 183 days, it's 121 days. That's really the rule. Tell the client they're in the United States less than 121 days a year, they're safe. Why do I say 121 days? Well, let's assume it's 122 days, right? 122 days in year 1, 1/3 of 122 days for year 2, 1/6 of 122 days in year 3. All right? Anybody got a calculator in their mind? 122 divided by 3 is 40.67, right? 122 divided by 6
21.
is 20.33, right? 122 plus 40.67 plus 20.33 is what? 183 days. You've met the test. You're now tax resident in the United States and subject to all that. So that's why we say 121 days. You can say 121 days in the US, you're not subject to US taxation. You don't meet the substantial presence test. Say 122 plus a year, you're a US tax resident, whether you have a green card, whether you're a citizen or not. Right? So people like Nick, who flies over to Miami every week, has to count his days.
There's an exception for medical purposes.
Yes, there's a couple exceptions, medical purposes, education purposes, and the like. Right? But be careful in Bahamas there on that late flight. Tell your clients, don't take it. Because if you leave at 12:01, you've added a whole nother day. Right? So
Who's monitoring?
If you arrive in the morning and say go back in the afternoon, does that count?
one day for one full day. One full day.
Who's monitoring?
Who's monitoring?
Well, you know, it's tough to know exactly how much the immigration people
The-
talk to the tax people, right?
The immigration people know exactly
Wow.
how many days you've been in to the day.
Yeah,
I know that for a fact.
yeah. No, they do.
They know exactly how many days you've been in.
So, I don't know if your client who's worth $250 million that you're managing their assets for, who's from Mexico and lives in Nassau and loves to go to the States all the time, I don't know if you want to take the risk saying, I don't know if they're monitoring or not. No, 121 days, period. That's what you advise your clients. Because if you work for UBS and they become a US taxpayer, are they a client at UBS anymore? No. You lost a client. Because you don't take US taxpayer clients. You've now lost your client worth $250 million. Right? You gotta be careful, that's why I'm saying you have to understand the tax parameters of your clients to be proper asset managers. Right?
You use the word, your client's tax profile. Well, how do you do that? Just getting questions like this, or do you?
Well, so being a relationship manager and asset manager means a lot more than just executing the trades that you think are right for their client. Today, like I said, you have to be intimately and personally involved in your client. That's the demand of the client, but that's the responsibility of an asset manager today. Before, when, you know, we didn't have tax transparency and taxation wasn't as important and we could take non-declared assets and nobody cares, it didn't really matter to you, right? Because he wasn't declaring it anyway. Right? And so you didn't have to be intimately involved with your client. In fact, your client didn't want you intimately involved with them. But today's different. Today you have to be intimately involved. You have to propose solutions. Right? It's very important for your clients. Now say you have a client, right? And we'll go briefly through this because this is more important in the tax class than it really is here. But say you have a client who's a US taxpayer but living in the Bahamas. Right? It's important for those Bahamians who have a US passport. You know, mommy took them over to Bornham in Miami just so they could have a passport so they could travel. You're a taxpayer. You're supposed to be filing taxes. Now the question is, you always hear about this exclusion. Man, I ain't got to pay for the first 100,000, so I don't make that, so I don't file. No. That's called the earned income exclusion, right? So U.S. citizens and residents abroad, right? And it's called the earned income exclusion. You could treat up to $100,800 of earned income excluded from U.S. tax purposes, right? And it's not taxable in the U.S. But you know the rub is, you have to file to get this. You have to file to be able to take advantage of that. So if you're not filing and you're advising your client not to file because they didn't make $100,000 in compensation income, this is compensation income, then you got problems, right?
So they could come, if you don't file for let's say 3-4 years, they could come and backdate all that, hit you with that.
Yeah. Yeah, you're not entitled to it unless you file. That's why you better file for your client going back prospectively, rather than them coming after and making you do it. Right? So how do you claim this earned income exclusion? And you get a housing exclusion and a housing deduction, right? So you have to meet these requirements. Your tax home must be in a foreign country. You must have foreign earned income. It has to be foreign, it has to be earned, and it has to be income. Right? It's a three-part test. And you must be one of the following. You must be a resident in the foreign country for an uninterrupted period for a year, or a resident alien who is a citizen or national of a country in which the United States has an income tax treaty, not the Bahamas, or physically present in a foreign jurisdiction for at least 330 full days in any period, 12 consecutive months. Right? And so the question is, your tax home, it's your main place of business, your main place of home. Clients who legitimately aren't living in the U.S., easy to satisfy. Right? You either meet the bona fide residence and physical presence test. Fairly easy. Most people meet the tax home test. The tax home is in the foreign country. Right? Question is, what is foreign earned income? That's really the crux of what this comes down to when you're advising your U.S. clients who are living abroad. Foreign earned income is income received for services. It's wages, it's compensation,
Not capital gains though.
not capital gains. Capital gains is not a function of your services, it's not earned. Right? And so, it's not interest, it's not royalties, not dividends. So all of that is taxable. You'll only get an exclusion for compensation and for housing allowances provided by your employer.
Even if the investment is not within the United States.
Right. Because you're a U.S. citizen, you're a U.S. person, taxable what? Worldwide income. Worldwide income. Right? So if I'm an artist and I'm producing a piece of art and I sell that piece of art, that's earned income because it's out of my labor. Right? Even though I'm selling a asset, it's out of my labor. So that is compensation.
What if you're in sales? So let's just say you invest in a product and you're in sales, and it's your effort that you're using to sell the product.
So that is commission based and compensation, right?
Okay.
Yeah.
Think about that.
Yeah. Absolutely. Because interest is always taxable. It's not earned income, right? So earned income, such as wages, salaries, professional fees, right? It has to be foreign earned income. So the source of the income is where you perform the services. So you have to perform the services in foreign. If I live in the Bahamas and I go to the States to work and I get paid for working in the States, that's not foreign earned income. That's U.S. sourced earned income. It's not part of this exclusion. It's taxable. Right? We'll go over the source rules in a bit, where you see where different types of income are taxable. Right? With respect to your question on capital and your capital investment, right? If your capital investment is an important part of producing income, no more than 30% of that can be considered earned income.
What do they consider as an important part?
Well, it's usually a facts and circumstances test, right? So it's probably more than half. Right? So, again, you figured out what the foreign earned income is. Now you've got to figure out the exclusion for your client. Right? You've got to figure out how much is excludable. Up to $100,800 a year. If you have spouses that are both American and both working, they can take advantage of that times two. But they can't aggregate it together. One can't make 150 and one make 50 and say we're aggregated out, no. They're treated separately, but each is entitled to their own exclusion. It's not a kind of marital unit exclusion. You know how many people get caught up in this? How many clients I have that don't file? Who live here? And then they want to know how to fix it? Now this is a more important aspect for your clients, right? It's the taxation, U.S. taxation of U.S. income of foreign persons. Right? So you have clients, you're managing their assets, they say, I want to invest in the U.S. I want to invest in a business in the U.S. I want to invest in private equity in the U.S. Right? I want to invest in real estate in the U.S. Oh, I hear wine is a new good investment. I want to invest in wine in the U.S. I want to do U.S. type of investments. Right? U.S. situs investments. And the question is, how is that taxable and where is that taxable? Right? And it depends on if you're engaged in a trade or business, or if it's a passive type of income. So clients may say, look, I want to invest in a business in the U.S. because I think this is an up-and-coming business in the U.S., and that's why I want to put my money in the business, not in a passive asset, but actually capitalize a business. That's where I want to put my egg. That's taxed one way. If you're not in a trade or business in the U.S., you are considered, and this is important right here, fixed to terminal, annual, or periodic. We call that FDAPI income. So you hear tax people call that FDAPI, right? Fixed to terminal, annual, periodic income. It's a fixed income. You are entitled to interest at 6%, determinable, annual, or periodical, right? That's taxed at a 30% rate. So this is taxed after deductions. We'll talk about trade or business versus FDAPI, because there are different types of tax regimes. So you have trade or business in the U.S., or you have FDAPI. FDAPI is 30%. Trade or business is taxed on effectively connected income. We'll talk about both of those. Right? You're a much better student than Miguel. Miguel was in my tax class, and Miguel, I think, came to maybe one class the whole year. So you have FDAPI income, you have trade or business income, right? You can have both effectively connected income, that's trade or business, and FDAPI income in the same year, and each will be taxed differently. So we'll talk about that, because your client is going to want to invest in U.S. assets. And whether it's bonds or businesses or trade or business in the U.S., it's important to know. So that brings you into source rules, right? And so you need to know, especially on FDAPI income, you need to know where it's sourced, because where it's sourced is where it's taxable. So when you're investing in assets for your client, one, you got to know the type of asset, where it's sourced, so you know what the tax is and where it's taxable, right? So, and these source rules are pretty universal worldwide. The U.S. just defines them very well, but they're pretty universal. So interest income, right? You invest in bonds for your client. And your client invests in U.S. issued bonds. That produces interest. Where is that interest sourced? Right? It's sourced where the obligation is. So if the obligation is out of the U.S., it's U.S. source interest. Interest is what? FDAPI income. Right? It's fixed to terminal, annual, or periodic income. Interest is FDAPI income. So meaning your client has to pay 30% on interest income originating out of the United States.
So there are no deductions on it.
No deductions on FDAPI income. It's passive, right? No deductions. Interest paid by a foreign company engaged in a U.S. trade or business is U.S. source. We know what OID is, original issue discount. So if I buy a bond for $900 and in 5 years they're going to return me $1,000, the OID, the original issue discount, is $100. That's treated as interest. Right? It's called OID, original issue discount. Sometimes bonds are priced that way. Rather than paying an interest, they're priced at a discount. Right? The place of payment is immaterial. It's where the obligation originates. So you could say, pay me in my UBS account, please, in the Bahamas. Doesn't matter. The obligation is in the U.S. The lender is or the borrower is in the U.S. So the interest is sourced in the U.S. and subject to tax. All right? Dividends. Dividends on U.S. stock are sourced where? It's the same logic as interest. Dividends sourced where the company is located. If it's a U.S. domestic company, dividends issued by that company to your client because you've decided to invest in that company are taxable in the U.S. Right?
And if it's not US.
If it's a foreign company stock, so if it's a UK stock, the source of the income is in the UK and subject to UK tax rules.
Right. So with the logic of worldwide income, that does.
Well, remember, this is source of foreign persons, not U.S. persons. If you are a U.S. person, you're taxable on worldwide income. This is for foreign persons generating U.S. source income. Right? So, interest and dividends are sourced where the obligation is being paid from. Personal services. What if your client says, look, I need a few $1 million out of the money that you're doing. I have an idea. I want to start a business in the U.S. But my business is going to be based on
Sorry, I'm late.
problem. How you doing? On my personal services, right? On my physical activity. That's what the income is going to be generated. I need some capital and whatever. My clients are in the U.S., right? But I'm an inventor. Right? And so I want to put some capital in that. You say, okay, it's important where you do the services. Because all wages and compensation are sourced where they're performed. So if you say, I'm going to go and spend half my time in the US, and I'm going to get compensated for that, and half my time in the Bahamas and get compensated for that, well, half of your income is sourced where? In the US, and taxable where? In the US. So it's much better if your client wants to invest in a business where the income is generated from his personal service, that you set him up in the Bahamas. Right? Because there's no tax in the Bahamas. He performs all the services in the Bahamas, even if his clients are in the US. I'm a computer programmer. That's what I do. I'm going to program for clients in the US. I'm going to do Bitcoin and blockchains and do this cryptocurrency stuff, and that's what I do. Well, I'm going to do it all in the Bahamas, even though I'm selling to people in the US. Because my personal services is sourced where I perform those services. So if you have a client that's looking to invest in something that he's going to generate the income from, better advise him not to do that in the US. Otherwise, he's taxable.
So if you're making an income, foreign income, and it exceeds 100,000.
Well, remember, this is foreign persons, not U.S. persons. The exclusion applies to U.S. persons living abroad. This is foreign persons generating U.S. income. Right? So there's a distinction there that you have to keep in mind. So this is a foreign person generating U.S. income as a result of his personal services.
So So what about FATCA?
Well, he's a foreign person,
So it doesn't apply to him?
doesn't apply to him. He's a US person, then that's what FATCA applies. Right? So we understand that. Foreign person generating income in the US. Rents and royalties. What is rents and royalties gonna be akin to? Interest and dividends, right? What does interest and dividends say? Where the obligation originates from is where you're taxable. So if you have rent on a US property, that's clearly what?
Taxed in the US.
US source, right? If you have royalties for IP for the use in the United States, right? Those royalties are taxable where? In the US. That's why everybody puts their IP in Ireland. Right? And they license it out of Ireland, and the license payments originate from Ireland. You give a worldwide rate, but it's an Irish rate, because they don't tax royalties in Ireland. That's why you got a lot of IP there. That's why they get Starbucks and Google and all of them getting all this bad boy problems, even though it's proper tax planning, right? Because you have jurisdictions that have created an IP low tax regime to be able to source the royalty payments there. Right? So clearly real property is sourced where the property is. I mean that makes sense, right? Because it's not movable. You can't move it. Right? Always US source of its US property. That's why when I showed you you invest in a condo for your client in the US, that generates rent and generates capital gains when you sell it. They're both US sourced. Now they're taxable at different rates. You can, remember the slide said you can have FDAPI income and trader business, where you can have different types of capital gain and ordinary income, but it's always sourced where the property is. Right?
But in that case, could you lend the client his own money, and then he deducts the interest payments
Yeah,
as a deduction?
yeah. Well, what you would do, well, you wouldn't lend the client in the Bahamas. You'd set it up in a US company and have that be the taxpayer. And lend it to the US company. The US company pays the interest deductions,
and then-
because the deductions are sourced in the US. If he's in the Bahamas and you lend him money for that, the obligation, everything is sourced offshore.
Offshore.
So you would want to structure the loan up here in a US co. Right? Because now you bring it onshore. The interest payments are deductible expenses that can go against the rent, but can't go against the capital gain.
But he can write the rent off.
But it can write the rent down, because deductions are attributable to ordinary income, not capital gains. That was the first few slides we did, so you guys may have missed that. So if you have an income producing asset, you gotta make a choice, right? And more so, you gotta make a choice on the type of entity. So let's take that for a little bit, because that's an important distinction. We're buying a US piece of real property, right? It's gonna be income producing property, right? And it's gonna generate $100 a year in rent, and you've bought it for $100. Or let's say $1,000, make it a little bit more, right? So what we call your basis, your cost basis in the property is $1,000. That's what you've given. Your rent's gonna be $100. You say, well, okay, I want to put a loan on this to write it off. And you form a US company, and you lend money, you lend $1,000 here, at 10%, right? So your payment out is $100, right? Let's say 7%, so we can have some gain. It's $70, right? So theoretically, this is deductible at this company level. Right? And your tax is $30. Your gain is, your income is $30 for the year rather than $100, because you deduct it. Right? The question you have is, do you want this to be a company or an LLC? Why do I ask that question? Different tax brackets, right? Your company is at 35%, right? And your LLC is at graduated rates, because it's a pass-through. So it's like a partnership, right? So it's anywhere between 19.6 and 39.6, I think, are the current rates. And you have to figure out where that falls in the bracket. And that'll help you choose this. Right? It'll also, the appreciation will help you choose this. Why? Because depending on how fast this appreciates and you sell it, companies, corporate taxpayers, don't have capital gains. Everything is taxed at 35%. Right? So if this is not going to be an appreciable asset, then yeah, you may want to be in a company. But if it's going to be an appreciable asset, you want to take advantage of the capital gains rate, you want an LLC. Because you get a flow through of the lower capital gains rate because you are filing as an individual. You're filing at the shareholder level. Because it flows right up to you. Now your client may not want to file. Your client may not want to tell the U.S. who they are. You know, a lot of people don't want to file tax returns in the U.S. So they may say, I'll pay the higher tax on the appreciation and just keep it at the corporate level and have the corporation be the taxpayer. Right? All these things are dependent on client interest. Whether they want a lower tax, whether it's an appreciable asset, whether it's an income producing asset. Right? All affect the way in which it is taxed. And that's why frequently when you're looking at these types of things, you want to hire a good tax lawyer. Right? There's one that works maybe about 500 feet to the east of this building.
And he's standing right in front of us.
Always ask him, you know, to help your client out. A very modest rate. So that's real property. When you're investing in real property, there's a lot of decisions that have to come into play. Because it's a lot of different tax implications, right? Personal property is not real property. Personal property is movable property, right? Personal property is generally sourced, this is odd, generally sourced to the person who owns it and where their tax home is. Right? So I have equipment in the United States in a warehouse. I'm living in the Bahamas. My tax home's in the Bahamas and I sell it for a gain. Where's that sourced? Bahamas. Beautiful thing, right? Beautiful thing. So it's not sourced where the property is located because it's movable property. Right? If I have artwork sitting in a warehouse in the United States, my personal artwork, and I live in the Bahamas and I sell it, it's personal property.
So same thing with vintage cars.
Wine.
Wine. Yeah. Sourced where the owner is.
Why would you want to sell one?
Actually, it's one of the highest producing returns in alternative asset selection in the world today. It's wine. I can't be in that business. I drink too much of it.
Not on the table, I said.
Right. So that was kind of FDAPI source income, right? We did source income on FDAPI stuff. Remember, we have trader business. So we had, you're a foreign person in doing business in the U or investing in the U.S., right? If you do that, you have FDAPI or trader business, T or B. FDAPI is generally at 30%, right? And it's effectively the passive type of income, right? Trader business is taxable on effectively connected income. Right? That's kind of how it flows. Effectively connected income is income attributable to a trader business. Right? You must be engaged in a trader business to be regarded as having effectively connected income. And that's always a facts and circumstances. It's based on the nature of your activities. Right?
What is a trader business?
So if I invest in a single condominium in the United States, is that a trader business?
No.
If I am a property developer and I build condominiums and I sell condominiums, is that a trader business?
Yes.
That's a trader business.
If I invest in a single stock, or I'm a passive stock investor in the United States, is that a trader business?
No.
If I'm a broker-dealer trading in stock,
Yeah.
that's a trader business, right? So it's facts and circumstances based, right? It's facts and circumstances based.
What was the percentage of the trader business? You have 30 for the FADAPI?
We're gonna go do that right now.
Oh, well,
This is how you determine trader business status. Right? If you're performing personal services in the United States as your business, you're generally engaged in a trader business. Because that's your business. Right? If you own a business in the United States, or operate a business in the United States, you're generally engaged in a trader business. So if my client wants to own a business in the United States doing whatever, give me something, property development, right? It's a trader business. If you're a member of a partnership that's doing business in the United States, as an individual partner, you're considered being in a trader business. Remember, a partnership for the United States purposes is a flow-through, so whatever that partnership is doing is attributable directly to the actual shareholders, right? Or the partners. So that'll be, that's a distinction, and the partners are the ones that file the tax return, not the partnership. Right? So first you have to be in a trader business in the United States. Right? Here's our example on broker-dealer versus trading for your own account. Right? If your only U.S. activity is trading in stocks through a U.S. broker, you're not in a trader business. Right? If you are a dealer or in stocks, and even if you're trading on your own account, but you're a dealer in stocks, broker-dealer, you are in a trader business. Bless you. So effectively connected income. This is where we figure out what we owe in tax. Remember, FADAPI is 30% on gross, right? And we said there's no deductions on FADAPI income, right? If you are in a trader business and you have U.S. source income, your income's effectively connected, right? If you have effectively connected income, then what are you allowed to take? You're allowed to take deductions that are attributable to your trader business. Because you are in a trader business, right? Now, the question is, before we get there, how do you know if certain types of investment income are attributable to a trader business? You know, generally we said rents are FADAPI, interest is FADAPI, dividends are FADAPI, right? All of these are FADAPI income. But you can have them be effectively connected income with a trader business if it satisfies an asset use test or a business activities test. It's two tests. So we have effectively connected income. We want to know if interest, dividends, rents, or otherwise, which are generally FADAPI income, could be effectively connected income. They could be effectively connected income if they meet one of these two tests, right? If an item of income is generated from assets used or held in a trader business, it's effectively connected income. Right? So if I'm a if I'm a developer, right, as part of my development activities, I rent the condos until I could sell them. I'm getting rents. Those rents are attributable to assets that are held in a trader business. and therefore those rents can be FDAPI income and subject to deduction. Right?
Repeat that.
Yeah.
If I'm a real property developer, that makes me in what? In a trade or business, right? Because I'm a real property developer, I'm not just have one condo. If I'm a real property developer, and I rent my units, my condos that I build, until I could sell them, say the market's soft, and put renters in. The question is that rent FDAPI income or effectively connected income? Because generally rents sourced from property in the United States are FDAPI, taxable 30%, no deductions allowed. I would want that to be effectively connected income. Why? So I can take deductions and lower the income level, right? Because the rents originate from assets, condominiums, that are being held and used in a trade or business, my real property development activities. Those rents can be effectively connected income. And as effectively connected income, I could take the deductions of the expenses attributable to my trade or business against the rents. So I'm not paying on the full value of the rents as if it was FDAPI. I'm paying on a lower value because I'm taking deductions.
Do they put a time limit on that?
Yeah.
Well, if I'm actually running a loss, I can carry it forward. Okay. Usually I would run a loss in my early years because I've got so much invested and not so many expenses.
Do they put also a limit on how many times you can do it? I mean,
How many times you can do what?
yeah, like you have a trader, if you have a trader business, you have a license, and you just do it all the time.
It's my trade or business.
Just
It's income generated by assets used in my trade or business. I'm allowed to treat that as effectively connected and take deductions
just go into
against it.
business, and do that to keep the tax, keep the right tax bracket.
You, Donald Trump, ain't never paid a dollar in tax, right?
I knew you were gonna do it.
He's a real property developer. He's in a trade or business. So it's not him. His companies, as a taxpayer, right? The business activities test, right, is another test whether FDAPI type income can be effectively connected. Right? So this is as a result of the activities of your business. So these two examples are actually very good examples of this. Dealer in stocks, right? If I'm a dealer in stocks, but I get interest from those stocks, from the activities that I'm doing, generally that interest would be FDAPI income. But because it's as a result of my business activities, it's effectively connected, and I can take deductions against it. Right? Same thing with royalties. If I'm in the business of licensing IP rights, and I'm getting rents or royalties from that business, or royalties, those royalties are effectively connected with my trade or business. And they're effectively connected to income, and therefore I can take deductions against what would otherwise be regarded as FDAPI income. You understand? Tax is very hard. That's why a lot of times you have to hire a good tax practitioner. Very complex, right? So this is why you might want effectively connected income, and this goes to Justice Nottage's question. Income received during the tax year that is effectively connected with your trade or business is taxed in the United States at the specific rates after deductions. Right? So remember, if you are an individual in a trade or business, it's different if you're a company. Remember the graduated 35% rate versus the graduated rates? Right? So I may be, Ryan has a U.S. LLC that is in a trade or business, right? I'm generating $500 of gross income a year, right? My expenses to run that business are $300, right? My net taxable income is $200, right? gross income minus deductions is taxable income. And then, that is taxed at my graduated personal income tax rate. So wherever I fall in the rate scale in the United States. So in the United States is a graduated tax rate. The more you make, the more you're taxed, right? So you say like for the first 20,000, it's taxed at 19.6. From 20 to 40,000, it's taxed at 22 point whatever, and it graduates up. And so that I'll be taxed at the graduated rate scale. It's taxable to me because it's an LLC, it's a pass-through. So Ryan Pinder has to file a tax return, right? If this is a company instead, the company's in the trader business, the company's the taxpayer, whether it be a foreign company or domestic company, and therefore the company's a taxpayer and payable at 35%. And so the question always is, do you do rate arbitrage? If you're going to be a zero-sum game here, because you have deductions, you have depreciation expenses on your capital assets, you have a lot of other types of expenses too. You may say, I don't want to file the tax returns, I want my company to file tax returns, I have a lot of depreciation and deductions, so I could write it all off to zero, and no tax, no harm, no fouls, not at the higher rate, but Ryan Pinder's off the grid. So you gotta do that balance sometimes with your clients, right?
It's voluntary.
You can choose whatever
You can
structure
choose
you can
whatever
choose whatever structure you want to go into invest in the United States.
And you, the foreign person, are taxed at the rate applicable to a US
That's right.
resident. So you go into a category
As an individual,
as an individual.
I
Yes,
go
not as the
I
LLC.
go into a graduated rate scale. But I'm responsible for filing the tax returns.
Yeah.
Right, I file a non-resident tax return. So I would file a 1040 NR. It's an individual tax return, non-resident. Which means I'm filing taxes on US source income only. And then within that tax return, I list what is FDAPI income and what is effectively connected income. And in that tax return, I list effectively connected income and my allocable deductions and depreciations and my net taxable income from the United States, and then I pay on that. So I may pay both FDAPI income and effectively connected income depending on my activities in the US.
So how does the position change if it's a vehicle, like it's a trust or?
Oops,
Sorry, how are you?
I'm good, how are you? Well, if it is a trust
That owns the LLC.
trust is generally a flow-through, right? So is it revocable or irrevocable? Grantor or non-grantor? Right.
It's irrevocable,
So if it's irrevocable,
but,
the trust is the taxpayer.
oh,
If it's revocable grantor, the settler's a taxpayer. Because US looks through grantor trusts. Irrevocable, they figure it's an entity unto itself. If it's revocable, grantor, I can terminate at any time, therefore I'm the taxpayer. Okay?
Are there any, typical businesses that you may, find under the graduated rate or, say under the,
That you would want to be taxed as an individual? Well,
say it's an LLC or
yeah,
company?
generally, unless you are generating so much U.S. source income, you're in the upper tier, which is 39.6, which is more than a company. Generally, it's a tax preferred position to be filing as an individual, right? Because you get the graduated rates in the lower rate scale. But many individuals don't like filing U.S. tax returns. They just, they have a phobia of the United States tax man. And so many persons will pay the extra tax in a company form to not have to put their personal information in the U.S. tax man. So this comes down to your client preference, really. And you explain to your client, look, and remember, we're talking effectively connected income. If it's capital gains income, it's a big discrepancy, right, in rates. Companies at 35, individual capital gains are at 15. It's 20% difference. It's more than double your tax exposure. So, and there's also, all right, let's better explain your question. I'm a foreign person. I'm investing in the United States. And the question is, I'm Ryan, I can invest either individually or through an LLC. You generally do through an LLC to get liability protection in the US, right? Because they like to sue you. Or a corporation. That's my choice. I can go individually, but individually is the same as an LLC, or through a corporation. Corporations are taxed at 35%. Individuals are taxed between 19.6 and 39.6, depending on how much you make in the US. Right? Individuals can take advantage of capital gains. Companies, no capital gains. Right? So the type of asset you're investing in is important. Third element that isn't depicted in the slides, but you guys should know about it, has to do with estate tax in the United States. If you die, even if you're a foreign person, and you die and you're holding US property, that is subject to estate tax. So if I own my condo in my name, or even through an LLC, and my condo's on Miami Beach, and my condo's worth $1 million, and I die, that $1 million is subject to US estate tax, 50%. My estate now owes the US government $500,000. It's in that fair market value, right? And so you always advise clients as well, when you're investing in property in the United States, you have to take into consideration estate tax. So now I'm investing in a $1 million property,
So the trust would be subject to that tax,
grantor trust.
but if it's irrevocable,
No,
they wouldn't be subject to that.
no, because I'll explain that in a minute. Right, so $1 million property. If I own the property, it is, and I die, $500,000 goes to the U.S. government, goes to Donald Trump, right? Nothing really changes if I'm holding it in a U.S. corp. Why? Because U.S. stock is considered U.S. situs. However, if I put an IBC here that holds the company or holds the property directly, and I die, what am I considered holding? Shares in the IBC. Foreign situs asset, even though through a chain it holds U.S. situs property, no U.S. estate tax. So that's why you always advise your clients, if they're buying property in the United States, to put it through an offshore court. Right?
If the LLC, if the IBC holds the shares of the LLC.
Right? Either way.
Okay.
Either way. Because my ownership is at this level. Right?
Do forgive me for being late, but LLC, just so I can come up to speed, that's
Right.
the,
Limited liability company. It's a type of entity in the United States. I apologize, that's a good question. It is a pass-through for US tax purposes, meaning it is as if it's me individually that has the tax effect.
Excuse
Bless
me,
you.
thank you.
A corporation, we call it a blocker. Call it a blocker because the corporation blocks the tax effect, and it's just at the US corp level, or even at the IBC level, because it's a corporation.
and the corporation pays 35% tax,
That's
and
right.
the LLC pays.
On a graduated scale between 19.6, 39.6, depending on how much you make. Right? So that's the estate tax implications of your advice. Probably not on your exam because it's not in the slides. But it's important to know. Now note, if you do this, what do you not get?
You know, the bid.
You not get capital gains,
Capital gain.
because it's a corporation. So for instance, one of my clients called me the other day. Says, Ryan, I'm buying a condo in Miami Beach. Right? Or he has a condo in Miami Beach. He says, right now I hold it in an LLC. How should I hold this property? I said, well, are you collecting rent? Or are you going to get a large gain in the property? Do you anticipate having a large gain? Or do you anticipate selling it soon, before he dies? Right, those are the questions you ask. He says, no, it's my second home, I visit there, there's no gain in the property, I don't anticipate a gain in the property, and I don't anticipate selling it anytime soon, right? Client is 65. So I say, well, if you don't have any gain in the property, you're not renting the property, you don't anticipate gain in the property, take it out of the LLC and put it in an IBC. Why? Because the capital gains doesn't matter, because there is no capital gains, or very limited capital gains. The estate tax is what matters. Because he's 65, the property's worth $1 million plus, and you need to protect him in case he dies. Rather than selling, because if he sells for 1.1 million, the difference in tax, it's 15% on 100,000 or 35% on 100,000. For him, the insurance is worth it in case he dies. It's better than 50% on $1 million. Right?
You said he's US or US?
Bahamian, Bahamian resident with US property. So if you have any clients, or you're managing assets for any of your clients, and your client says he wants to buy real property in the United States, you got to figure out if he's doing it for capital gains, if he's going to flip it, if he's going to hold it, if it's a second home, how old he is he sickly, is he healthy, right? Because the nature of how you hold it is important. Well, the taxation is hard, eh? That's why people hire tax lawyers. And so back to this, right? Effectively connected income. Now this goes to Nick's question before. I may have misled him a little bit. Right? So if I have income from real property in the United States, right? Still on real property, right? And I hold the property for the production of income, right? It's a rental income. I'm not in the business, I'm not a developer, but I own a few condos, right? Now you own a few condos and I rent them. I'm not in a trader business, right? I have 4 condos, investments, rentable units. Not in a trader business. That's generally what? FDAPI income. Taxable at 30%. And I generally cannot take the interest deduction that Nick thought I could take, and that I told him I could take. Right? Unless I'm allowed to make an election for real properties producing income, this is a limited election, to treat that real property as effectively connected income. And therefore I get the deductions.
How do you get the limited election?
Limited income.
Yeah.
Limited.
Is it
How do you
limited?
get the limited election?
You file a form with the IRS.
How many times can you do that? Many times?
And what's the time limit,
I don't know if you, I think it's a permanent election. I don't think it's an annual election. It's a permanent election.
What are some of the deductions when you look at point 2? Right, when you talked about your net income, so I know you could probably look at.
Interest, right? If I borrow money to buy it,
Right.
interest. If I have a maintenance expense, right? Maintenance expense. If I have to, repairs, right? Depreciation,
You pay a management fee to yourself.
Hmm?
You can pay a management fee to yourself.
Yeah, any related management fees?
Is there a standard percentage for the depreciation? Like,
Yeah,
for example,
so in the Internal Revenue Code, they have depreciation schedules. So depending on the type of assets, you depreciate. I think real property has a 30-year depreciation schedule, I think. I haven't looked at the depreciation.
But if you've got a real
schedule.
property that's appreciating,
50?
if you've got a real property that's appreciating and you take the deduction, the depreciation, then when you sell it, your capital gain's based on the depreciated amount, not the purchased
Larger.
amount.
That's right. So what Nick is saying is, if I buy the property for $100, right? And my depreciation expense every year is $5,
Right.
right? $5, and I hold the property for 5 years. That means I've taken 5 times 5, right? $25 in depreciation expenses. This is my basis. Remember, I call this the cost basis. My cost basis, my adjusted cost basis, is now $75. If I sell the property for $150, right? My net taxable income is what? $75. If I did not treat it as effectively connected income, and I sold it for $150, my taxable income is $50. See?
But do you have to take the depreciation? Or do you
No,
elect
I have,
to take it?
you elect it when you elect to be
You do,
effectively
so-
connected. Because I may be renting this one, and therefore it's better for me because I'm netting out the rent every year. Right? If I'm renting this one, if I'm renting it for $5 a year, and I have income of $5, I have depreciation expense of $5, it's now 0. Right? And I'm getting $5 tax-free a year. And I'm adjusting my basis downward. Right? Now, to Nick's point, this gain is actually bifurcated when I sell it. Because the Internal Revenue Code says I have to recover my depreciation expense against ordinary income. And so $25, and this again is a little bit more in depth than what's in the materials, $25 is ordinary income and $50 is capital gain. Otherwise, everybody would be effectively connected because they're going to take ordinary income deductions and producing a capital gain. It's tax arbitrage. The United States would never let you do that.
how difficult is it if you start off as an individual and then you want to move to channel it through an IBC? I mean,
It's just your tax reporting changes, right? So your tax reporting's on an annual basis. So for year one, I may hold it as an individual and I'm filing an individual non-resident return on my US source income. Year two, I've put it in an IBC. Putting it in the IBC is not a taxable event. But now my IBC is the taxpayer, not Ryan. And therefore, as my IBC the taxpayer, my IBC files a non-resident return, but he's a corporation. He's filing it as a corporation at 35%, right? Rather than me at the graduated rates. But you can do that year by year because it's not a taxable event. Putting it in the corporation is not a taxable event. It's just a different taxpayer for that year, right? Okay. Oui. Okay. That's the last piece anyway. Now we're all trust people in here, so we all like to know about trusts, right? And CFCs and companies and entities and the like. So we'll go through this one real quick. Let me just send it over. Okay, I'm good. So we're going to talk about U.S. taxation of foreign companies owned by U.S. taxpayers. That's what this little discussion is going to be about. Okay. Major advantage of a U.S. person doing offshore international business and using a company to do that business through is tax deferral. That's really the biggest avoidance game in the United States, is deferral. It's the biggest avoidance game. It's not a game because they pay tax lawyers to do it. Avoidance schemes. I don't mind using the word scheme, but the OECD hates that word. Is tax deferral, right? Why is deferral so important? Because you can compound what you would otherwise be paying in taxes. Right? If I make $100, right, and my tax obligation is $35, right? I have $65 to reinvest that year. If I make $100 and I defer the $35, I have $100 to invest that year. Say I make a 10% return. I now have $72.5 or $110. I go through this exercise again and again and again and again. You could see the compound effect on tax deferral. It's enormous.
Does it ever end, or is it just a?
You're taxable when
perpetual?
you have a deferral scheme. You're taxable when you bring the money back as a distribution or dividend, or if you sell the company. All the tax comes up, right? So deferral is the biggest game, right? Apple Computer, just to give you a context. I'll give you two examples of deferral. Apple Computer, right? You hear Apple Computer has billions of dollars in cash offshore, right? You look at their balance sheet, they have billions and billions and billions of dollars in cash offshore. Why? Apple Computer is a US taxpayer with offshore operations through an offshore company. Therefore, the income is deferred because they don't bring it back. They keep it offshore. When Apple Computer's shareholders demanded a distribution, a dividend, because they have so cash rich, you know what Apple Computer did? They issued a bond at 6.5% in the US to pay the dividend, because it was cheaper to pay the 6.5% than it was to repatriate the funds that were accumulating and deferred all those years offshore. Right?
So what do they use that offshore? They just continue to
They continue
invest?
to. Let's use an example close to home. Templeton. Templeton Advisors is a U.S. company, headquartered in Fort Lauderdale. Sir John was a U.S. person until he renounced. All of the U.S. advisory work for Templeton is done in their U.S. company. All of the global expansion of the Templeton Advisory Service originates out of the Bahamas. Why? Because Sir John bifurcated Templeton early on. U.S., foreign. Foreign was based in the Bahamas. He loved it here. No taxes. All the advisory work globally was done out of the Bahamas. Non-U.S. advisory work. As he collected money and money and money, he didn't repatriate that. He reinvested that into his global empire. And so all of Global Templeton was capitalized by the offshore non-U.S. operations that were based in the Bahamas. They never pay a dividend. Right? That's why the big Templeton Global funds, you know where they're managed out of? Life for Key. Managed out of Life for Key. RBC Capital is doing the same thing. Invesco is doing the same thing. Invesco Global is based out of Life for Key. Same reason. Deferral. It's all about deferral. It's the most significant tax play you can do. Now that deferral has to be a result of operational income. Right? Can't be passive income. Can't be investing in stocks for your personal account on a passive basis. Has to be operational business to get that deferral. Right? So we do schemes all the time. I have a real property developer that's US based. He wanted to do development in Costa Rica. So I operationalized his development scheme and through the Bahamas and Costa Rica, where the Bahamas was the operational development arm offshore. And we just kept all the money offshore. And then we paid a management fee to bleed it out as he needed it. But he was actually managing the business. So he paid on a compensation basis, but most of the profit stayed offshore and reinvested in other projects. Right? Has to be operational business.
But he has to effectively manage that from the Bahamas. He couldn't have a Bahamas company and operationally manage it on the phone from the US. for
Right,
example.
because it's personal
Because
service
it's personal
income, and
service,
personal
yeah.
service income is sourced where?
Where
where you perform the services. Right. So, deferral is the biggest scheme, right? The next thing we want to talk about are controlled foreign corporations. These are important. CFC rules. Have you heard CFC rules? Controlled foreign corporation rules, CFC rules, right? If you are a controlled foreign corporation and generating passive income, even though that income never touches U.S. soil, you have to pay tax on it as a U.S. person. That's the concept, right? So we are in a non-operational income scenario. And controlled foreign corporation regimes are becoming very popular worldwide. Latin America is putting them in left, right, and center. And so, what is a CFC? A CFC is a company where 50+% of it is owned by what's called a U.S. shareholder, right? That's a term of art. U.S. shareholder is a term of art. So if this IBC is 50+% owned by a U.S. shareholders, it's a CFC, and therefore passive income is automatically attributable to the U.S. shareholder in the year it's earned, regardless if it's distributed. Okay? So what's a U.S. shareholder? A U.S. shareholder is somebody who owns 10% of the voter value. So I have to own 10% to be a U.S. shareholder. Right? So if this IBC, right, has 11 equal U.S. persons as shareholders, do I have a U.S. shareholder? No. So therefore I'm not a CFC. So therefore my attribution rules don't come into play, because I'm outside the CFC regime. Right? If I have 9% shareholders and 19% shareholder, that's foreign. So these are U.S., these are foreign. Do I have a CFC?
No.
No. So I don't have any 10% shareholders.
But it's voting stock
Voting or value.
or value.
Or. Voting or value. Right? Combined voting or value. If I am a U.S. shareholder of a controlled foreign corporation, so I am a 10% shareholder, and there are enough 10% shareholders to put me over 50% U.S. shareholder owned, then I have to pay in that year on what's called subpart F income, passive income. Just think of it as passive income. I mean, I'll list all these are types of subpart F income, but I don't think you're declaring illegal bribes and kickbacks, right? I mean, if you are, you've got other problems. Tax is the least of your problems if you're declaring you're collecting illegal bribes and kickbacks.
Especially if you're declaring them.
I think you're going to jail. So really, it's really only what we call foreign-based company income, which is passive. Just think passive, right? You automatically include that in the year earned, regardless if you distribute. So if you have a client who, and this, like I said, this is happening all over the world now. Brazil's getting ready to put in CFC legislation. Chile has it. Mexico has it. So if you have a client who owns more than 50% of an IBC, and that IBC is investing in financial assets, passive income, you have to ask him, do you have a controlled foreign corporation regime in your country? Chances are they probably do. And therefore, they have to impute that income in that year on their tax returns, regardless if they actually receive that income. All right?
So why would they put that, I guess that part in there with bribes and Is it because it's legal in some countries?
Oh, because they want to lock you up and tax you for it. Right? And so if you're being found to have received illegal kickbacks and bribes, they don't only want to lock you up, they're going to say, well, you had subpart F income in your IBC. Therefore, you should have included that in the years that you received it. Oh, and you received it every year for the last 10 years and didn't declare it? So you get penalties for not declaring, you have interest on the tax due, plus you have the tax due. We want all of that money back. And so that's a way for them to take the kickbacks and put it in the US Treasury, frankly. Right? So, I mean, like I said, I'm not going to go piece by piece on this. Couple things to note. Foreign personal holding company income, that's the passive type of income. Foreign-based sales company income. So you can't use your IBC just as a sales center, as a processing center, as an invoicing center. That doesn't give you the deferral. Right?
Before you move on.
Yeah.
A lot of this is new to me.
Yeah.
I see a lot of references to IRC.
Internal Revenue Code, Section 9954D. I just referenced it. I don't expect you to read the Internal Revenue Code. There's a tax lawyer down the way that can help you with that. But the Internal Revenue Code is, especially in the international area, is very complex. But that's just a reference if you want to go see where it's referenced. So you have passive income, sales income, so you can't just be an invoicing center, right? And services income. So you can't just plant services income, if you're a US person, plant your management fee in a non-operational IBC and say, I'm deferring that. No, they capture that as a CFC. And they say, the reason is, they say, well, you're performing the personal services, just because you're putting in a company, you shouldn't get the deferral. Therefore, we're attributing it back to you. Right? So those are the main types of income that get caught in CFC regimes. Now lastly, and I only have a slide or two on this because it's very, very, very complex. Probably the most complex part of the Internal Revenue Code. And it just so happens to be in an area that we all practice in, right? Mostly are exposed to. Trusts. We're a trust jurisdiction. And like I said, the US treats trusts as that are settled by US persons or have US beneficiaries as flow-throughs. Right? And they categorize trusts as domestic or foreign, depending on what you do. Now, as a corollary to this, you hear a lot of times, a lot of clients are now going to the US and setting up US trusts to try to do tax reporting arbitrage with FATCA versus CRS, right? That's why you have North Dakota trusts and Delaware trusts and all of this stuff. And so they choose a US trust versus a foreign trust for that purposes. A lot of people choose foreign trusts for other purposes, asset protection purposes, better trust laws, and the like. Some people choose LATAM person may choose the Bahamas as a legitimate jurisdiction for their trust, but have a child who's a US person and a beneficiary. How do you treat that? Do you now get sucked into the US tax rules because you have a child that is a beneficiary of a US trust, a foreign trust? You do. And so, what is the US? How do they classify a foreign trust versus a US trust? Now this is important. I made this point actually to my partners this week at Graham Thompson. Because one of our partners said, well, all the trusts are going to Delaware. We are in big problems as a jurisdiction because they want to be US trusts, and therefore they have the arbitrage on reporting with FATCA versus CRS, right? FATCA has a more limited scope. We'll do this next class of reporting. CRS has a broader scope. Let's go to the US because they don't report on the same basis, right? You are a US trust if you meet two conditions. A court in the US exercises primary supervision, and one or more US persons has authority over the trust. So my point with them was, look, I get that. I get people are going to the US to do their trust because of FATCA, but we should be telling them another story. we should be saying, look, you actually want a Bahamas trust because our law is better, our asset protection's better, right? There are legitimate legal reasons why a Bahamas trust may be better than a North Dakota trust. We have more experienced trustees than the guy in North Dakota that's hiding under the bush, right? Because they don't have any experience up there. So you do a Bahamas law trust. Your choice of venue for disputes is where? No. No. You have to have a court in the U.S. You could choose Bahamas law, court in the U.S., and trustee in the U.S. You are now a Bahamas trust that's considered a U.S. trust for U.S. tax purposes. I said, that's what we should be doing. Right? We shouldn't let all this business go away. We should say we understand why you want to be a U.S. trust. But you really want to be a U.S. trust under Bahamian law. And therefore, as your lawyer, I have to draft the trust deed. And you can have a Bahamian asset manager. And you can have a custodian in a Bahamian bank. You can do all of that. But for FATCA purposes, you are a U.S. trust. The only thing we're giving up really is our trustee services.
Yes.
But you can have dual trustees. Because it says one or more. So you can have a dummy U.S. trustee, and the material trustee is in the Bahamas. Right?
What's the benefit of having the U.S. trust?
So we'll talk about this next class, but FATCA, under the current regime, if you're a U.S. trust, you're under FATCA, and then your information exchange under FATCA is much more limited than under CRS as a trust. And the U.S. doesn't ascribe to CRS. Right?
CRS is the acronym for...
Common Reporting Standard. That's the global automatic exchange regime. The next class is dedicated completely to transparency rules. We'll dive deep into that. Right? And so a foreign trust is a grantor trust, meaning if it's a look-through trust. The U.S. regards it as a look-through. If the grantor retains the right to revoke the trust. So it's a revocable trust by the grantor, by the settlor. It's a grantor trust, and it's a complete look-through. So no matter what the tax is, what income is in that trust, it's automatically attributable to the settlor. That's how the U.S. treats it. Right? And I think this is the last, yeah. This is the most complex part about foreign trusts of U.S. persons. It's called accumulation rules or throwback rules. If I have a trust, right, that has a U.S. beneficiary, and it's a discretionary trust, and this trust accumulates income. I don't distribute all my income. I accumulate it. Right? The U.S. puts a penalty tax called the throwback rules, an accumulation tax, on the trust for accumulating the income that wasn't distributed to the U.S. beneficiary. So it really bypasses the whole discretionary concept. Why? Because they automatically attribute all the income to the U.S. beneficiary. Right? And so a lot of trustees may get into issues with this by not distributing the income to the U.S. beneficiary. DNI, distributable net income. Right? Now the calculations are very complex, and it's a very complex regime. So you ask, what do you do? Right? This is a little planning note. I'm not going to go into the calculations, very complex. So if I have a trust, right, and I have a LATAM settler, which we always have, and my LATAM settler has a bunch of beneficiaries, right? 3 beneficiaries foreign and 1 beneficiary U.S. Right? And it's a discretionary trust. What we write into these trust instruments is for this U.S. beneficiary, instead of him being the beneficiary, we have a U.S. trust as the beneficiary, and the beneficiary of that US trust is the US citizen child. And what do? We distribute all of the allocable income to this beneficiary into this US trust. Now, you have to pay income tax on that, but you have to pay income tax anyway, but you relieve the throwback rules here,
So you can still,
right? So you can still accumulate
Accumulate in
here for these,
in the top tranche.
and you can accumulate here for him. And you only pay the tax on this distribution. You can accumulate on a deferred basis here, because a US trust is considered a deferral entity. And you only pay tax here when it's distributed. And so that's how you plan for your family who has
One.
US and non-US beneficiaries.
In the absence of the domestic trust for the US beneficiary, I guess in all cases you always have to make payments.
You always have to distribute income straight to the beneficiary, but the settler may not want to do that.
Well,
He may be an alcoholic, he may be still in school, the settler may want the child to get on his feet first before he gets income. There would be a whole host of family planning reasons why you wouldn't do that, right? And this US trust could be what? It could be a Bahamas law trust, a US court,
US.
where one of the trustees is the US, and so your trustee up here can still be trustee for this and primary trustee for that, as long as you have a secondary trustee in the US. So you can make this a Bahamas law trust, that's a US trust for US tax purposes,
But it's still a Bahamian trust.
but it's a Bahamian trust.
But you say you don't have to defer when you do.
You have to pay the income from here, the income at this level, when you distribute here, but income that's accumulated thereafter is deferred until it's distributed here. So it's like it's a two-stage taxation, right? You're still paying the same tax, because when it comes here, this becomes a stepped-up basis to be reinvested, and it's only there. Any questions? Pretty meaty, hey?
Yeah.
Meeting.
Very.
Should take my tax class, we'll do it all over again. All right, before I go to dinner, next week we're doing financial privacy and tax transparency, that's the entire class. We're doing tax information exchange agreements, FATCA, and CRS. And in CRS, we're talking both multilateral and bilateral. As you would know, the Bahamas is reverse positions and is now going to be a multilateral jurisdiction. So we'll talk about both in that.
Calculations that you're giving us with the taxation portions and stuff, those are gonna be on the.
No, only what's in the slides.
Oh, and that's on the slide.
So do we need to bring a calculator?
Nope. I design my courses, I design my curriculums, less calculations and more kind of fundamentals, because ultimately, this is what? An asset management course? And what does that mean? That means you're advising your clients on how to invest their assets. You're not tax lawyers. You're definitely not tax lawyers in their jurisdiction. Therefore, I don't teach that. Like, I'll give you an example. In the tax class that I do, the person that teaches trusts does UK tax calculations in her class. I think that's very unfair. I don't do any calculations in my modules. I just don't believe it's the right thing to do for a class setting like this.
Another question, LLCs that we deal with, there are two types. The attorney keeps talking, about in reference to how don't you have a manager?
Okay, yeah.
LLCs and stuff.
So that's just, this isn't on the test, but just to clarify that for you, just so you understand. You can have a member-managed LLC or a manager-managed LLC, right? The only difference is, in the LLC, you can appoint a manager, right? Who is really only a manager,
Yeah.
or you can say, my members, my shareholders will manage my company.
The manager appointment is more tax.
No, has no tax effect. Has no tax effect. But like, if I have if I'm investing, if we're all investing together, right? Through an LLC. And we're investing in real property development. None of us are developers. We may do a manager-managed LLC and have the manager be somebody who's experienced in real property development. rather than us as members trying to manage a development project when none of us have ever built a house before in our lives, right? And so that's why, it's really a governance thing, it's not a tax thing.
So technically, the manager should be the property manager of the property.
Well, no.
Someone who has knowledge.
Somebody who has knowledge in what the investment structure is gonna be in, yeah.
Or you could also, is it possible you could also consider hiring a manager just for some of the projects?
Well, that's what, yeah,
You
I
should
mean,
hire a property
that's what so we may invest in, we may come in and then invest in a number of LLCs, right? This one we may do member managed because all we're doing is managing our assets.
Right.
These are maybe doing real property developments in 4 different states in the United States. And therefore, we may do these as manager managed, and the manager, who has all the governance rights over it, is a person with experience in that state.
How difficult is it, or how costly it is to set up LLC?
What, $150, $200?
Easy.
Easy. We only make things difficult in the foreign countries, you know. Are we good to go? Everybody understand? We're all tax experts? Or at least we know when to call one, right?
We know who to call.
500 feet to the
More
east.
importantly,
About 500 feet to the east. There's one that works, it's on the 3rd floor, right? Extension 334.
Actually, it's 498.
Pardon me? It's 498? Okay. Okay. All right. I have a dinner appointment at 8. Good thing it's not too far from here. If there's any questions, my email that you can use is rpinder@gmail.com. Okay? rpinder@gmail.com.
And we're still on for Saturday then.
We're still on for Saturday morning at 9:30. I have all the trust documents.
Different one.
No.
No, that's a different.
Taxation review.
don't lose a DD.
No, it's right there.
He's just walking out the door without it.
I wouldn't have gone far. Okay, everybody, it was a pleasure.
Thanks, Ryan.
Yeah.
Have a good dinner.
Okay.
So, this tax class on Saturday, that's something different.
Yeah, it's a different course.
How's the new job? Did you say you were going to?
I want to, I'm still looking.
I thought you said you were
No, I
going.
haven't left because I started to teach in in September. So for 6 months around. So but I'm ready to jump ship now. Like anybody will take me for summer. I'm ready. It was rough today. It was rough.
Oh, Lord.
Yeah, same job today though.
So you're still working with, I think you said the Trouble You Day. It's a good job, you know, and I mean,
You
you
know
say
how
you.
people say they have like the horror stories from like their employers or their managers? I have one of those. So it's a constant back and forth with the supervisor. The job isn't so bad, the pay could be better, but she makes it even worse. So yeah.
You performing a Bible service?
Yeah, but then you gotta compensate me for that Bible service if you can't.
It's
try
become,
it.
you know, I always remember, you
Yeah.
know, listen to me.
In
I always-
$50 increments, what I can do with $50 a month? My gym membership costs $150 a month.
I know, but just be patient and come in. That reminds me of when I started banking, that was what, 34 years ago, right? And of course I jumped ship because I jumped from Barclays to Commonwealth to CIBC, then CIBC merged to First Caribbean, now they're back to CIBC. And over time, it just, what I did was, like you do, I went to school. And even now I'm still in school because one of the things I want to look at doing and why I'm doing this course is I want to get to the point where when I look at and listen to these politicians and see the crap that they're doing, to me, you got to start thinking overseas. And I'm trying to get into trading eventually because you're going to need to have sources of income outside this country.
Right.
You know, and every government that comes in blame the next one, but I've never seen it this worse. I was listening to Steve McKinney yesterday, and man, he was talking about how we're in dire straits.
Oh, let me stop this for him. I think.
You know what Miguel needs to do? Why these things be